Good evening, guys. My name is Michelle Poirier, and I'm going to be doing a ratio analysis of two industries. And from those two industries, I will pick the two best performing firms and then compare those two firms to pick the best one to invest in. The first industry we are looking at is Aaron Parks, which is comprised of Textron, AeroVironment, General Dynamics, and Boeing. First, we are looking at the industry averages for all the ratios that we have computed today. We will be handling short-term solvency first. Here we have our current quick and cash ratio. This here is just showing that the industry holds a lot of inventory and not as many receivables or cash on hand. Next, we are looking at long-term solvency, and here we have compared the equity multiplier and cash coverage ratio. For the industry, the equity multiplier takes a large jump at the end toward here, and that is caused by one firm and their equity multiplier, which I will explain later. Next, we are looking at asset management, and for this we will be doing total asset turnover. Now, it looks like there is a large variation in total asset turnover, but really it is just a large variation between 0.86 and 0.89, and this is 5 years of data. Next, we are going to be looking at profitability, which will be comprised of profit margin, return on assets, and return on equity. As you can see, return on equity is again affected by that one firm and their very large jump in equity multiplier. Last, we will be looking at market value measures, which will be comprised of the price earnings ratio, market to book, and EVA. Price earnings and market to book in this industry have stayed relatively low, not fluctuating at all. As for economic value, on the other hand, we have seen some large fluctuations. All right, and now we're on to the firms themselves. Here we can see that AeroVironment, represented by the yellow line, is above average on current ratio, quick ratio, and cash ratio when compared to the industry, and also when compared to every other firm. The other three firms are below the industry averages in all of these categories. And what can explain that AeroVironment is so off from the industry average and the other competitors is that they are inefficient with short-term solvency, either by keeping too much cash on hand, too much inventory. Next, we are looking at our long-term solvency, and here we can see that equity multiplier is skyrocketed for Boeing. Now, what caused this is in 1 year, Boeing went from an equity multiplier of 25.7 to 155. This is not what we like to see as investors. They are trying to leverage too much with debt, which we will see in future ratios. As it goes for cash coverage, General Dynamics can pay their debt more times than any other firm in this industry. When it comes to total asset turnover, we see that most of the firms are close together and above the industry average, minus AeroVironment, which again is the yellow line. General Dynamics, we can see, is growing, and Boeing again is growing right above General Dynamics. Now, when it comes to profitability, we're going to have to bring back that equity multiplier of Boeing and see how it has large effects on return on equity. That is what caused such a large spike. And return on equity is the single most important ratio, but we don't like to see it leveraged with debt that much. We can see that General Dynamics has the highest profit margin, and that is what is driving their Profit margin is highest for General Dynamics, which is driven by their operating margin, which we can see reflected in profit margin, return on assets, and return on equity. When it comes to their market value, we can see that each firm fell in 2015, and that's not terrible because this is the price earnings ratio, which any ratio above 21 means that the firms are probably highly overvalued, which we can see here they all fell to below or at 20. And they're now generally growing. And when it comes to market to book, we see that Boeing is skyrocketing again. And Boeing in the EVA spread is again showing inconsistent and drastic increases. And General Dynamics has had a consistent economic value added growth. So who do we choose to invest in? We choose General Dynamics. They have shown better consistencies in return on assets, profit margin, which again, profit margin is driven by their operating margin. Total asset turnover is growing at the second highest rate compared to the other firms in this presentation. They're not relying on equity multiplier to leverage their ROA, and they also have consistent, positive, and growing economic value added. Now, when it comes to the next industry, we will be looking at the adult beverage, and it will be comprised of Craft Brew Alliance, Boston Beer, Constellation Brands, and Molson Coors Brewing. We are again going to look at the industry averages first before delving into the firms. Adult beer industry holds very little in cash. We can see that it is mostly in inventory, which will show the large gap between current and quick ratio. Adult beverages long-term solvency, we can see that their equity multiplier industry average is extremely low, whereas their cash coverage is extremely high. That is what we like to see as investors. They can pay their debt on average the industry many times over. Now, their total asset turnover looks like it takes quite a dip, but again, when you look at it, it falls from 0.89 to 0.78 to go back up. This isn't that much of a change, but we do like to see that it is now growing back. Now, when it comes to profit margin in this industry, it is fluctuating year to year, which is not the best to see, but at the end, again, they are all profit margin, return on assets, return on equity are all pretty much going upwards. Now, when it comes to the market value of these firms, we can see that price earnings and market to book are constant. Price earnings seems to be falling a little bit, but growing, and so is market to book, whereas economic value added for the adult beverage industry is all over. It is completely scattered. Now we're going to analyze the firms individually against each other and the industry. Boston Beer has had a lot of fluctuations, as we can see represented than the other companies, but it may be inefficient with cash as it is so high in cash ratio compared to the other companies. Boston is represented by the yellow line. Now, when it comes to long-term solvency, again, the equity multipliers are all within one value of each other. It ranges from 1.5 to 2.5, so we don't see adult beverages using debt to leverage gains. We do see some fluctuations, however, in cash coverage ratio. Craft Brew Alliance have been quite volatile. Constellation has seen small but consistent growth, and Boston Brew can barely afford its debt. When it comes to asset management, total asset turnover is falling for Boston Beer. Constellation has seen consistencies, although lower than the average. The industry average is represented by the blue line. And when it comes to profitability, a large operating margin for Constellation in 2014 is all the peaks that we see with the brown line. That is what's causing it. And we can see that it peaks and it falls, but again, it is slowly back going upwards. And Molson Brewing experienced its own peaks, which is represented in green, but has then had sharp falls after its peaks. When it comes to market value, all companies are currently around the same price earnings. We can see some of them have large fluctuations, but as it ends in 2017, they're all right next to each other. Each company has their own year that they are peaking with economic value added, but we see, unfortunately, that most of them have fallen in 2017. So when it comes to choosing who's the best to invest in the adult beverage industry, we want to choose Constellation Brands. They have a relatively smaller short-term solvency and less cash coverage, but throughout all ratios, there is more consistency. Operating margin is the main driver in ROE and ROA. Small total asset turnover can be due to the amount of brands that it sells, making it harder to completely turn over its inventory compared to other companies. They're also currently the highest valued with the large market to book ratio. Now when it comes to choosing between General Dynamics and choosing between Constellation Brands, we want to go with General Dynamics. As an overall, the air and parts industry experiences a lot less fluctuations and changes when it comes to the adult beer industry. So aerospace is more consistent when compared to the adult beer industry. General Dynamics is better investment than Constellation. ROE is high and not driven by equity multiplier like its competitor Boeing. So this is the company that we want to choose from. When it comes to their suppliers, they have 108 suppliers. Supplier power is not large, there's no risk there. And when it comes to their buyers, their number one buyer is the USA. And every year the dividends are increasing with General Dynamics. They have not posted a dividend smaller than the prior quarter or year. So this is what we want to invest in for our company.